Hello, everyone. My name is William Mucker. I am a client executive with CamaPlan, and I would like to thank you all for joining us for today's webinar, Investing Passively Using Your Self-Directed IRA with Charles Sells. As a quick note, please be aware that Charles will be answering questions at the end of the presentation. However, feel free to use the chat and or Q&A function on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. CamaPlan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at CamaPlan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. And once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I would be more than happy to help. And without further ado, I'll pass the controls over to you, Charles.
Wow, that was fast, William. All right. All right, let's just jump right to it, guys. Let me make sure I've got the right screen for you here.
Looks
good.
Right.
Okay, so we are talking about investing passively using your self-directed IRA. Most of you that are on this call probably know what an IRA, self-directed IRA is, but did you know only 13% of Americans actually know what a self-directed IRA is? I imagine the numbers probably come up a little bit in the last few years as people have been looking for ways to diversify their retirement savings and their portfolios. And that brings us to, where's your 401k at today? Average 401k balances have plunged 23% year over year since 2020. This was a report from Fidelity as of November 17th, 2022. So that was closing out the year there. That's an average of losses of 69% in 2020, 2021, and 2022. That's just a mind-blowing amount. I mean, can you imagine, you started out 2020 with $100,000 in your bank account, and now you got 31,000. That's just absolutely mind-blowing. So where are we in 2023? Well, we're not losing anymore. We're not hemorrhaging money, but we've only gained back 4% of that 69%. So is that good? Or is that, maybe it's better than losing anymore. That's for sure. So it brought me to the question, and we all love Google, obviously, and this is exactly what I put in. What average rate of return on a 401k can you expect? Now, we're not talking about the last 3 years. We're talking about good years. So let's say 2014 to 2019 were good years. The answer is that they typically pay anywhere from 5% to 8% per year. That's a pretty low number. A lot of people are pretty happy with an 8% return on the money to be investing passively. But what we're going to do is we're going to use the law of averages here, and we're going to say you're going to get back 6.5% per year, even though it's only at 4% right now. And that means it would take you 10.5 years to get back what you just lost in the last 3. Now, it would be nice if more than 13% of Americans actually knew that they could take control of their retirement savings and put it to work the way they want to. And there's a lot of things you can do with a self-directed IRA. I'm in real estate. That's what we're here talking about today. You can put it in all kinds of different types of real estate. You can put it in tax liens. You can put it in fix and flips. You can put it in rental property, short-term vacation rentals, you name it. Private funds and offering. I'm going to touch on it for just a second today, but you can literally be a private money lender. You can be the bank, and it pays certainly a lot better than 8% to be that bank. And you get collateral, you get first lien against the property, just like any other mortgage. Let's say you wanted to open that dive bar that you've always been dreaming about, and you finally got the opportunity. You can use your SDIRA to open it up and start a new business. Bitcoin and crypto, not my favorite. I don't like something I can't touch and have 25-year-old kids running multi-billion-dollar companies, but that's an option for you. And I mentioned the private lending. So promissory notes and lending. We do this almost every day, where self-directed IRA investors want to fund one of our other traditional investors, and they'll pull the hard money from them. Now, we've used to use institutional hard money lenders, and we still do from time to time. But since 2020, and with the continued rate hikes, the hard money has become very hard to come by, for one. But also the terms they don't make sense. It's the interest is too high. Leveraging your capital is always a good idea, but it just doesn't work. And then if you want to stay in the stocks and mutual funds that have been losing the last 3 years, you can do that too, but at least you're in control. So who are we? So Strategic Passive Investments, we are titled as a service provider within the real estate industry. In that time, in the last 24 months, we've done about $30 million in transactions. Now, that is in fix and flips. That is in buy and hold properties. Well, that's primarily it. We haven't been in tax liens for a few years now. I've been in business for 27 years. I started this business when I was 23 years old, and we've just grown it exponentially over those years. We've always offered high yield, conservative, and consistent double-digit returns to our investors. So it's certainly above that 8% we mentioned. Numerous peer rewards and accolades over the years. Yes. Can you buy them? Yes. I have not bought mine. And we are industry recognized for our transparency and tenacity. I sit on a number of industry-related advisory boards. One currently is a oil and gas that we'll touch on very briefly. It's a $180 million hedge fund. I was previously part of a $150 million hedge fund in tax liens, and I essentially became their independent auditor, if you will, because they were just leaving money in county offices that was not working for them. So what do we get into? We're in fix and flip, buy and hold real estate, tax liens and tax deeds, short-term vacation rentals. I mentioned private lending to you, and it works both directions. We could either be a borrower or we can be the lender. Yacht charters, that sounds crazy. Why would we be in yacht charters when everything else is real estate? Yacht charters became extremely big and extremely popular, just like Airbnbs during COVID. It was literally one of the only places you could get a vacation, and it's here to stay. Good colleague of mine approached me about it, and essentially it works exactly like a short-term vacation rental. I mean, all the tools, all the clearinghouses, everything you go through works the exact same as a short-term vacation rental. Other than the fact that it's on the water, and your expenses are a little more, but so are the profits. So that's why we're in it. It's essentially a short-term vacation rental. Oil and gas, that seems equally as strange. About 3 years ago, somebody approached me about fixing and flipping oil wells. And I said, what are you talking about? And essentially that's what it is. So again, using my real estate hat, I could envision how this works and how profitable it can be, even with the current administration trying to shut down drilling here and oil production here. Now, something we always say is, one, when you invest in real estate, it's how you buy the property, not how you fix the property and sell the property. It's always about buy right. We also say, live where you want, invest where it makes sense. So we've been in the Savannah market now about 8 years. Prior to that, we dabbled a little bit in Savannah, but we were in other areas like Greensboro, North Carolina, Winston-Salem, those kind of areas. We decided, and thankfully, it's a wonderful thing, it's in our backyard. We decided to just essentially bring all our resources into Savannah because we saw that there is amazing opportunity coming our way, and we wanted to be the biggest, strongest boots on the ground when it got here. And that's exactly what's happened. So it is what I call America's hottest market. These two pictures here just show you some of our activity in two specific areas that we've done in the last 4 years. The one on the left there, we call that the state streets because essentially every single street is named after a state. Maybe it's the one on the right. It is the one on the right. Just in the last 4 years, we have watched that area increase in value 132%. Now, I don't have it today because I have a lot to cover, but in my other presentations, I actually show you where we had one renovation on the same street, 2 blocks, same side of the road from another renovation from 2019 and 2020. where we actually saw the increase in the cost per square foot for what we sold the property for was in excess of 132%. So the market here is just absolutely booming. Nothing is correcting itself. Nothing's going away. The demand is still there. We are seeing purchases slow down a little bit because interest rates are so high. And a lot of that, I think has to do with the media. Yes, we were all really enjoying 2% mortgage rates. That couldn't last forever. We're at the highest rate we've ever been in 23 years. But if you think about that, where does that take us? That takes us to the year 2000. The real estate industry was absolutely booming in the year 2000. Yes, a number of that had to do with the bad loans that were getting written, but nonetheless, the market was booming then. So, and that was at 7%, which is where we're at today. So it's really not as bad as the doom and gloom they make it out to be. Home values in Savannah are all based on infrastructure, which we're going to cover. But while other parts of the country have slowed down, plateaued, flattened out, or even backpedaled a little bit, we had a 29.1% home value increase in 2022. We're on track to be at 24% for 2023. So 19.6% is where we're at as of last week. Rents in Savannah are off the charts as well. People aren't buying right now because of the high rates, so there's a massive demand for rent. I would think these numbers have actually tweaked a little bit since getting them, or since they were reported anyhow. But we've grown by 42% in the last 4 years. That's nearly triple the state average, and I can't even look at what it is on the national average, but I'm sure it's up there in the top 5 as well. Rents are up nearly 33% in the last 6 months. And it says 52% of housing in Savannah are renters. I would be willing to bet that number is closer to 60% right now. So the infrastructure, why is Savannah so hot? And it's all about the infrastructure. It's about what's been going on for the last, well, we'll go as far back as 15 years. It all started with Savannah College of Art and Design. And essentially what they did is a model that Charleston used during the recession. Essentially, Savannah College of Art and Design has bought up all the dilapidated commercial buildings around town. They get great tax incentives for doing so, and that becomes the campus. So what does that do? That means investors like us come behind them and they buy up all the residential properties. Well, now you have urban renewal. You're essentially revitalizing the city with these incentives, if you will. So that's what's going on. Everything you see here is the Savannah campus, and it's all over the city. They're actually even branching out even more now. They've just bought a few more buildings for campus. They just built a 17-story, we're going to call it a high-rise. It's a high-rise for Savannah, dormitory on the river. So they are continuing to build out the city, and that started about 15 years ago. In addition, for the last 4 years, Savannah has transported more containers through its ports than any other port in the country. Now, when you think about ports like Long Beach, California, Los Angeles, New York, Miami, that's a lot of containers we're moving through this piddly little port. In fact, we're on year 3 of a 10-year track where we're expanding our ports. It's a collective between South Carolina and Georgia. Since Savannah River borders them both. And it's going to be the largest port in the country. Obviously, with that comes a lot of other good jobs and moving things around the port. We also have Gulfstream headquarters. Now, I moved to Savannah in 2004. And when I moved to Savannah at the airport, and it's actually called the International Airport because of Gulfstream. There's no other planes that actually fly internationally other than the Gulfstream planes, but they get away with it regardless. They had one manufacturing building at the airport, where they put these planes together, build them up, whatnot. Big one, it's pretty big, probably 400, 500,000 square feet. They've now quadrupled that. They have 4, and they're building the 5th. So jobs, obviously, growth and expansion for a very wealthy industry. We also have JCB in North America. Now, many of you haven't heard of JCB, but you've heard of Caterpillar. JCB is the exact same thing as Caterpillar, only they cater more to the military and the international clientele. So your earth movers, your tractors, your bulldozers, all of that is manufactured here in Savannah. So they're much larger than a Caterpillar, and you know that manufacturing is done right here. Amazon. Now, we all remember years ago when Amazon was talking about putting fulfillment centers in Raleigh, and I believe there's a spot in West Virginia they were going to put one, and they maybe have. But real estate investors were flocking to that area just based on the idea that they were actually going to go there. Savannah, little Savannah, not Raleigh, not a big city. We just got our 600,000 square foot fulfillment center. This slide says 2022, but nobody is beyond being subject to the labor shortages and material shortages we've been facing since COVID started. They actually just got the doors open a couple weeks ago. So there's the ribbon cutting there with the governor and a number of past mayors of Savannah there. You know, as Bezos said, real estate is the key cost of physical retailers. That's why they all saw location, location, location. So we've got that there as well. Now, as a fix and flipper, novice or seasoned, one of the first things you want, or the first things you learn, is you want to be investing in a military town. Again, it's not where you want, live where you want, invest where it makes sense. Why military town? Because you've got constant influx of transients. You've got permanent residents, but you've also got transients, which makes it a great rental market. We have two major military bases. We have Hunter Army Airfield. That's where all your Black Hawk helicopters are trained. And we have Fort Stewart. That's the third ID. If any of you know the military, the third ID is the ones that are first boots on the ground at the front lines after the Marines have gone in and secured the area, if you will. So two very, very massive military bases right here in Savannah. A biggie we got last year, which has been kind of interesting to watch because we had limited housing to begin with. And with this factory coming in, it's a scramble to get new housing built, to get rent ready for you know, vacant housing, because you've got, you know, an influx of new population that's come in. So Hyundai came in with a factory right next to Savannah, which is also the 6th fastest growing county in the country, and they brought in $5.54 billion to build this EV facility. What that created was other manufacturing companies coming in to supply the parts that will supply Hyundai. So you've got metalwork coming in, steelwork coming in, just a huge influx. You know, it was a big deal that Hyundai was creating 8,000 new jobs. And then with all these other folks that started coming in after that, we're up to like 21,000 in new jobs. With all centered around this Hyundai factory and its production. We've also got tourism. So again, layers upon layers upon layers of opportunity and support for these investments. Before COVID, I always said Savannah was recession proof. COVID obviously tested that and then proved me right, more or less. You know, throughout COVID and even now, we have done nothing but grow and grow and grow. I showed you that one slide of 29% in 2022, 19% on the way to be 24% by the end of the year. That's more than a 50% growth in appreciation in 2 years. That's insane. National average is 5. Number 4 best city to visit in the U.S. last 12 years. We will be number 1 coming up in the next few years because the Savannah Bridge that is right there at the ports, in addition to expanding the ports to get bigger ships in, they've got to raise that bridge. When they raise that bridge, then we're going to get cruise ships in here. And obviously that is a major dump of cash into our economy, into our local economy. You know, 5,000 passengers a day jumping into the streets of Savannah, that's obviously going to be enormous for us. Here's one I bet none of you knew. Georgia's film industry ranks number 1 globally in the production of top grossing films. Hollywood isn't even in the top 3. So it's Georgia, i.e. Savannah, United Kingdom, Canada, California, Louisiana. So Hollywood's no longer Hollywood. And what this is doing, again, Savannah is growing so fast. There's not enough. There's not enough housing. There's not enough hospitality, like hotel and whatnot, to accommodate all this influx when it comes. So you don't have a ton of uber luxury mansions for a celebrity to come stay in. So it's become a challenge. That's what we're going to be talking about a little bit today as well. So getting into real estate, there's a number of different ways to do it if you're novice or if you're seasoned. Working with a service provider like us gives you a lot of leg up. One, it gives you it mitigates your risk. You're putting that risk on somebody's shoulders who's done it a lot more than you ever have, has taken the losses, knows how to work the system, and can produce. This particular property looks huge. I know we're not looking for one investor here. We bought this one just at the onset of COVID, right before the shutdowns, and we paid a pretty penny for it, and we put quite a bit of money into it. But it's taken us that long because it's such a prominent property in Savannah that the Historic Society, essentially, all they've let us do so far is put that balcony back on that you see there and paint the building to preserve it. That's all they've let us do so far. Now we finally have gotten through all the hurdles and all the headaches, and we're ready to bang this sucker out and reap the rewards of it. I mentioned homes for celebrities, and we decided, with all of this going on, that we would actually bring the interior designer of the stars to us. And she actually comes out on October 10th. And we're going to walk this property, and she's going to get the renderings done and the drawings done. And she basically has a clean palette. She's free to do whatever she wants because she knows what these people want, and that is our end user. We will sell this home to, either a celebrity themselves, somebody very rich in Savannah, or a production company that does a lot of their movies down here, and they'll use that for their housing needs. So the palette, like I said, it's very clean. We have gutted the entire place. Something unique about us versus most people who flip houses in Savannah, at least, is we obviously have a lot of old homes on soft ground, and they settle. You can walk into a beautiful $800,000 Victorian home that's completely been redone, and the stairs will literally lean as much as 3 inches from one side of the stairwell to the other side. What we do is we literally just rip it down to a shell. Even the flooring comes out. We put all new flooring in. We use laser levels for that. All new electrical, all new plumbing, everything comes out. And we essentially just keep the shell, start from scratch on the inside. And that's why our properties exceed most of what goes on in the city. As Bezos said, and as you guys have heard, location, location, location. This property is so well located. We literally couldn't ask for something better. As you can see here, the green circle, that's a square. The green square is what was formerly a Kessler Collection hotel called the Mansion. That has since been closed down, and they are building where all that parking lot is behind. They have built out the hotel, and I'm going to show you some pictures at the end of what it looks like. But with building out the hotel, they have limited their parking, obviously. Now, the square in red, that's our property. So that's the one we're looking at right now, the big prominent one. And we own the one just above it as well that says 804 and 105 on the slide. We own that one as well, and we're going to talk briefly about that one as well. You see the Forsyth Park band shell there. Now, every weekend, there's some kind of event going on here. Farmers market, trade shows, jazz festival. We have a big jazz festival here in the fall. And that's actually what we just had. So this is kind of a zoomed in of what that theater, that band circle looks like, and what the park looks like. So it's a very popular park and a very good location, centrally located in the middle of town. That yellow arrow there on your bottom right corner, that is actually pointing to where this property actually is. So very good location, right next door to the Mansion Hotel. Really couldn't do any better. The Bardo now, it's being called the Bardo. Just another perspective of what it looks like and our proximity to both the park and the Bardo Hotel. So fractional partnerships. On this particular one, it's a minimum investment of $100,000. The previous slides said we had about 1.4 we wanted to put into it. And anticipated completion date is May 5th. So we've gotten through all the headaches and all the hurdles. So we're ready to get going on this. We actually already are going on this. I'll show you a quick video of all the new flooring we put in and more flooring that's going in. So gross profit on this investment, $2,971,864. Now, before any of you click out of here, because that seems absurd, I've done this many times before. Like I said, 30 million in 24 months. I know the market, I know the city, and I know how to make these returns. And we're going to show you some examples of that. So what we're going to do is, since we have brought in interior design to the stars, it's a first-class package, obviously, to include her flights. But what we do is, once we have the renderings, and that could be within the next 30 days, we'll market the property at that point. We'll market it for sale at that point. So as soon as we have the pre-sale renderings, we're going to market it for sale. We're going to shop it to the production companies, and we may have it cashed in before we even hit that May date. Majority of properties that she's done for a resale have all been sold prior to any of the work actually being completed. So how does this work with a self-directed IRA? And this is getting to the meat and potatoes, if you will. So obviously we're the service provider. Nobody here, well, some of you may have, the full investment amount of $1.4 million to put into this. But let's just assume you don't. So how does fractional work? You're an owner. So let's just take very quickly, we'll take, the group on the far right. Maybe they don't have an SDIRA, or maybe two of them have a SDIRA, and the rest are just investing with traditional funds. So with our help, they can set up an LLC, and the two that have the self-directed IRA, they can own their portion of it while the others own their portion of it. So it's strictly set up just like a joint venture, but it's through an LLC. And if you had 50,000, you really wanted to be into this investment, and your other person had 20,000, you didn't quite make the minimum, you can partner all of these folks together and essentially invest as a collective. The next one, you've got the retired couple. One's got 50,000 in their account, the other's got 50,000 in their account. They meet the minimum. They can partner theirs as well, and they come in under the minimum cap. You've got the guy here. He's just got $100,000 parked, and he's ready to invest. And then you've got the next guy. He's got a ton of equity in his house, and he's going to use a HELOC, home equity line of credit. He's going to pull out some cash out of the HELOC to get that 100,000 minimum, and he's going to park it with us. And then the last guy, he's just sitting on a bunch of cash and needs to put it to work. So all of these folks become our partners. We're all partners in this. The LLC that's on the far right is essentially investing in another LLC, which is our LLC that owns the property. So they're actually getting ownership of everything. So every one of these players is now our partner in this project. So we're all partners. We're all working for the same cause. And we all have the same legal documents that says John Smith owns 20%, et cetera, et cetera. So all of that comes back to us. We take care of everything. And now you're investing passively. We're handling the construction, the raw materials, the painting, the plaster, the planning, the safety, the document clearance, the equipment, everything that goes into this is being handled on your behalf. The way it works is essentially you get a Dropbox link to a special folder that has all of the progress and videos that's going on with this project. And you're just checking in on that every few weeks to see how things are coming along. So this is a little off. My numbers are a little bit off because I rounded up the percentages of ownership. So it threw everything off by about $1,000. But nonetheless, you've got the first guy with 300,000 cash. He's only owning 6.6%. I say only, but look at the money in hand. He's still making a profit of $195,000. And so this breaks all the way down. Obviously, we have the most ownership because we've been in it for a long time. Sure, we'd be happy to sell some more. if we needed to, but this is the breakdown as it sits today as an opportunity. So how that plays out is your investment now is $4,528,136. Now I'm going really fast, but we are recording this, so you'll be able to get a copy and go back. So that's your investment. Now, something I forgot to tell you is that the value of that property as it sits today is $4.3 million. So after we deploy all this capital, obviously the price is going to go up and up and up and up and up. So we're going to be in it for way less than it's going to be worth, because we're literally, as we're sitting at it right now, we're not talking about a big difference. So what I want to point out here is these profit margins. Let's say that I haven't been investing in Savannah for all this time and haven't flipped all these homes. And I don't hit that mark of selling it for $7.5 million, which is a 65.65% return. Let's say we shave it with a haircut of $1 million. That's still a 43.57% return. And keep in mind, we're to be at market on or before May 5th. We're going to try and sell this through renderings as soon as we have them. So when you annualize that, if we're in it for 6 months, that number doubles essentially. Let's just say that I completely screwed up. We had to rip out all the walls and start over, and it cost us another $1 million. And all we got out of it was 5.5. So that's still a $970,000 to $72,000 profit, or a 21.48% cash on cash return. That's gross, obviously, but the cost for attorney's fees and agent fees and that sort of thing really isn't going to take that big of a dip into this scale of a project. So how's your investment collateralized? I mentioned that you're a partner, and you are a partner. So you get LLC shares, you get recorded ownership, a security deed against the property. And as I showed you that last number, you have equity in the property. I mean, you literally have equity before you even get started investing. So you have equity already in it. Now, what you can't do with these LLCs is you can't say, hey, I'm going to go buy this house. I've got this investment that has $300,000 worth of equity in my name, and I'm going to use that equity against my loan underwriting. You can't do that. It has to stand alone, if you will. This is just what a form looks like as far as real estate joint venture agreements go. If anyone wants the full size of it, it's about a 4-page document, and I'll be happy to share that with you. This is what an operating agreement looks like. This is for a different property that we did. Same idea. Scale was a lot different. This was a $600,000 short-term vacation rental, and we had 3 people involved in this one. But this just shows you exactly, this is the document the attorney uses, and this is important for everyone to know. When we go to close this property, the funds are not coming back to SPI, and then I'm distributing out to you guys. When we take this document, when we close, the lawyer is going to ask for our ops agreement. That's what this is. This is the ops agreement. And on it, on the last page of it, it shows, SPT, 66%, Helena, 10%, Joe Smith, 5%, and so on and so on. So the attorney then takes all those funds and distributes them based on those shares. So that is going to be wired directly to you. It's never going to come into our hands as it's going out to you at the sale of the property. This is what a security deed looks like. It's again 2 pages of what is usually a 3-page document, and it just shows that you've got a deed to secure the debt. You have a deed representing your ownership in that particular investment. So you got basically 2 very, very strong documents which provide you with the collateral that you thereby need. Now, very quickly, I'm going to play this video that shows where we're at as of today, the proximity to the park there. On the right, that's what has taken us a little over a year to get approved with the Historical Review Board. You see that staircase, the black staircase? We have been fighting and have spent so much money just trying to get that ingress egress out of the property. Well, this is how the property looks as of well, as of today, as of last week, we'll put a big sweeping spiral staircase like you see in Gone with the Wind in the center of the main ballroom there. If it remains a ballroom, we'll see when Carrie Whitman gets out here. By the way, that's the name of the interior designer. Her name is Carrie with a K, Whitman. You can Google her, see who her celebrity clients were, and a lot of her work. It's pretty spectacular. But that just kind of shows you what's going on now. You can see we've got people in there as we speak, reframing where we need reframing, and so on. So now I'm going to jump pages a little bit. And as I mentioned, we own the property right next door to this too. Now, for me, this one is not as aggressive as that one is. But it's long term. It's not short term. So you've got long term investors, you got short term. So this is a completely different project. So investments on this one are as low as $30,000. Why are we doing them so low? Because my biggest client, who now has about $10 million parked with us, he started out with $50,000 just to test the waters with us. So I can't shut out what is the small guy, because it might not be a small guy. So this is an opportunity to invest in this property. Fractional corporate housing. Why are we doing corporate and not VRBO or Airbnb? Well, that's a great question for a different webinar, but essentially deals with the fact that the entire world is sick of Airbnbs, and they're starting to put a lot of restrictions in place and make it very difficult to turn your house into an Airbnb. So that's the short answer. So this is long-term cash flow, or as I mentioned, if you want to be a private lender, you'll get 16% per year annualized on a short-term lending opportunity. Same rules apply. You get a security deed against the property with a lien position in place, and you have that collateral. We can never sell the property without paying you off first. And again, it goes straight through the attorney, not through us. So on this one, we're talking about 8 units, $3,000 a month each for corporate housing. Corporate housing also obviously is in huge demand because of all that infrastructure I showed you. Those execs have nowhere to live right now, and they need corporate housing. We have a teaching medical hospital here as well. Those travel nurses right now, they make $3,600 a week, and they need a place to live. Why not be right at the park? So $3,000 a month for corporate housing is what we're doing with this particular property. So gross of $24,000 a month, not including the parking. The great thing about Savannah, and I'll get to that in a minute, is parking is at a critical level of necessity, and it's not there. This property comes with 24 parking spots. So the current investment in this was 2.1. All we're looking for on this one is $820,000. The after repair value on this is 5.7. So your total investment is almost as much as the total profit we're going to get out of this property. So 96.6%. So, the caveat is we probably wouldn't refinance this for a few years, and we would just let it pay itself off. We'd collect the cash flows, and we would distribute those based on your particular ownership every quarter. This property is very close to being done. This is the Bardot on the left. That picture had to have been taken from the parking lot. So this is the uber luxury hotel that they're getting ready to put in. On the right are our parking spots. So again, 24 parking spots that we will be renting for $45. Well, negotiating right now for $60 per parking spot for the hotel per day. I imagine we'll probably wind up somewhere between $35 and $45 per spot. So the revenues on that, 20 spaces, $36 a day, it's $21,600 a month. So we're almost making as much as parking as we are in renting the property. And if they bite on our $60 per spot per day, we'll actually be making more in parking than we will on the property. And keep in mind, appreciation. We are literally right next door to what is going to be the most uber luxurious hotel in the Savannah area. That is going to be just an absolute game changer. Weddings in the park, putting people in our houses, our apartments for spillover. Lots of opportunity for this particular property. So when we add in the parking, we've got $547,200 in gross projected income on this particular property. On a $3 million investment, that is absolutely outstanding. So the gross cap on that is 18.69%. I mentioned earlier that averages in Savannah, averages nationally are 8.4%. So we're blowing that number completely out of the water. And what does it have to do with? It's the parking. It's absolutely the parking. And again, let's just say that I'm completely wrong in my abilities to do anything with real estate investments. Pre-COVID, appreciation in Savannah was 12% year over year for the previous 7 years. So we were already on fire before all of this happened. So not considering the after repair value, between the gross cap and the years prior appreciation prior to COVID, you would earn 93.45% in gross revenues over 5 years with a value appreciation of 60% in the property itself. So take out all the ARV and everything else and just look at the cash flows and your appreciation. And the numbers are still through the roof. So this is a great one. It's why we wanted to start with a smaller investment amount, because we know that small folks will become big folks. These type of investments do not happen every day. Our averages, our investors make about 20%. We have a 16% promise. That is that the worst you can do with us. But our investments normally average about 20% annualized. So this is how close we are. And to the novice eye, it doesn't look like we're very close at all. But we've run all the electric, all the plumbing, all that's been upgraded. And we have, as you can see there, we have 8 HVAC units in the property. So once you're at HVAC, you're 80% there. We're keeping all the floors. Those are original floors that were done in 1907. And we're just going to refinish them, sand them down. So these will be 1 bedroom, 1 bathroom with a nice kitchen, uber luxurious. So these are the renderings for this building. And why are we going uber luxurious? Because everybody in Savannah that has a historical property, 1, they don't fix it right, and 2, they think everybody wants that old time feel. We tend to think like the people at the hotel next door. Yes, but they also want the modern amenities. So you want that old time feel. You want to stay in a building that has this history to it, and has seen a lot of things. But you also want the modern luxuries that you've become used to. So inside this will be uber luxurious, furnished units. So is it practical? Are these numbers I just mentioned even realistic? Like I said, I've been doing this a long time. These kind of deals do not come up all the time. It's a rarity for sure. But yes, we have done it in the past. This one was done with leverage, and the client net profit after we took out our fees, and our fees were fairly substantial there. He had a 286.9% profit in a 12-month investment. So that's remarkable. One we did about 4 years ago. No, I'm sorry, it hasn't been that long, about 2.5 years ago, was a beach house. And this beach house broke my heart because the person that ended up buying it, they ended up gutting it and making it way worse than what we had done to it. But it was a descendant of the McDonald's family, so they had the money to do it. So our profit on this particular investment was 98.97%. And it's 1 year and 5 days because what happened? Well, closings don't always happen on time. And this was a hard money loan through an SDIRA client. And the terms had a penalty of $28,000 if we did not close it out when the loan matured within 1 year. Normally, we would try to negotiate that a little bit, but there was enough profit in this that we didn't really care and didn't want to slow it down anymore. So this is what it is today. 2.5, call it 3 years later, the valuation, I don't trust Zillow at all. But just using their valuation, they value it at over $1 million more than what we sold it for. So again, just goes to show you how this market is absolutely on fire. regardless of how other markets have changed. I'm sorry, not 1 million more, 2 million more than it was 2 years ago. Jeez. The net return does not include $250,000 in rental revenues for the summer we held it. So what happened was this house had massive termite damage. And with that, we literally had about 60 floor jacks, car jacks, that lift the house up. You take out all the supporting beams, you put in new beams, eradicate the termites, drop the house back down. So that took some time to get all of that taken care of. Well, with doing that, I thought we were going to miss season. So missing season, I wanted to come up with a way that we could make more money and be able to carry on. So what we did is we furnished this entire place, and it rented anywhere from $15,000 to $25,000 a week. So we able to, obviously made good cash on that as well. So our profit on this was well over 100% if you include the rental revenues that we got out of it. And I already mentioned that it didn't include the $28,000 penalty we had to pay for being 5 days late. Now, I mentioned private lending. This is the only slide I have on this because I know I'm running short on time. But these are our terms. If you want to be a private lender, depending on the project, we pay 11% to 19% annualized. It's paid either at the end of the sale of the property, or it's paid monthly. Again, it just depends on the project. So terms and timelines are based on the project. These things run anywhere from 6 months to 24 months. And again, you're the bank in this position, earning 11% to 19%. So you're first position lien against the project property. So you have a lien against the property, just like a mortgage would have a lien against your property. It cannot be sold, transferred, or anything else until that lien is paid. Now, I'm coming to the end, so if anybody got questions, now would be a good time to get in there. These are, I know I blew through this really fast, so you may have questions after you rewatch it. But getting started is very easy with us, strategicallyinvest.com, and my email is charles@strategicallyinvest.com. And if you just have questions in general, you're not ready to invest, but you just have questions in general about anything related to real estate, I probably have that answer to that question, and I'm happy to help.
Great. Thanks for the information, Charles. As Charles said, now's the time. Use the chat function, the Q&A function on your screen. Everybody should have access to ask Charles any questions that you may have about what he just went over. Or if you have questions about self-directed IRAs in general, I'm happy to pitch in as well. So please use the chat now while we have Charles with us.
Yeah, and I know people get nervous about asking questions, so I'll answer one that should have been asked. Do we have any concerns about selling this $7.5 million property in this currently volatile market? And the answer to that is no. Most people at that level, they aren't initially financing it, if you will. It's more or less self-financed. They have their own shell companies that have cash in them. It looks like a mortgage. They're still able to write off the interest, but it's done all internally. So the type of buyers that buy those kind of properties, like McDonald's, they're not going through a mortgage company. They're not paying today's rates, which are 7.1%. With the one next door, I did mention that we will eventually refinance it, cash all of us out, and just let the property essentially appreciate and pay for itself. But we won't do it right away because we are subject to today's current rates, and it would be problematic for us to be invested at $2.9 million, and now we're going to refinance, and we're paying over $1 million in interest on a 15-year loan.
Perfect. Thanks for that information, Charles. We just had a question come in. You gave some great examples of projects that have gone well. Can you give an example of some projects that haven't? What happened and why? It's a great question.
That is an excellent question. So yeah, I mean, we're not perfect. We've done better actually through COVID than prior, but prior to COVID, what we call it is a fail rate. was about 6%. That means that, 6% of the time we lost money in the investment. I mentioned briefly that the worst you can do with us is 16%. So what that essentially means is that if we get into a situation, and it happens all the time, we're working with distressed real estate, where we start peeling back those walls, or we find those termites, and obviously that stuff eats into the profits, and it can be substantial. So if we lose in that situation, we come out of pocket to you. And I mentioned in the very beginning that working with a service provider like us helps mitigate those risks, and that's a perfect example of how those risks get mitigated. We can absorb something financially disastrous much easier than you can, we've seen investors that go out there and do it on their own. They've been watching all the reality shows, and they just end up losing their life savings on their first project. With us, you've got a backstop that, worst case, I'm going to get 16% out of this investment. So yes, we definitely absolutely have lost on some projects, but we've been also very, very fortunate that Savannah's economy is doing what Savannah's economy is doing, because there have been some situations where we have actually done better by getting delayed due to labor shortages, which is still a problem for us. Labor shortages are, but it was a quadruplex, commercial. It was an 8-bedroom, 4-bathroom Victorian home, again historic. So we had to go through all the hoops. But we were expecting to get that thing off our books about 18 months ago, and we would have been happy with 1.2 at the time. Push come to shove, dealing with historical society, dealing with the board, dealing with approvals and everything else, it took a lot longer. Now we're ready to close on that, hopefully early next week. We're just waiting on windows at this point, and refinance it. And the appraisal came in at 1.8. So with Savannah's economy, even when we think we're about to lose money, we're actually ended up making, a good amount. And I'll be happy to get that one off the books, because it has is carrying a lot of cash load right now, because again, we're not using hard money loans on that particular project. So yeah, absolutely, stuff happens, but it's not going to happen to you. It's going to happen to us.
Great. Thank you for the great question, Jenny. She actually has a follow-up, but thanks for that answer, Charles. The follow-up from Jenny is, in the long-term hold scenarios, do you also pass on the tax depreciation to your investors as partial owners of the property?
Yeah, absolutely. You're legit partners, and we use third-party accounting here, so we don't fudge all the numbers ourselves. So absolutely, the depreciation is passed on to you guys.
Great. Thanks for the other question, and thanks for another answer, Charles. Another question coming in from Mark. Mark asks, return sounds too good to be true. I am familiar with income funds and limited partnerships, GP partnerships. I came in late. What is your history experience?
Yes, it is too good to be true, but it's really not. Yes, I work with LPs, GPs, JVs, all of the alphabets. We've done in Savannah, as I said in the beginning, we've done about $30 million just in the last 24 months. These two particular unique investments are unique. These don't happen all the time. Our averages returns are about 20% annualized to our investors. But these are two that we have had on our books since the week before COVID shutdowns. And with that, we've been working with the architects and the city and the historical boards and everything else. So really, time is on our side, which is what makes the returns look so sexy. Now, if you come in as an investor 2.5 years ago when we picked these up, you would have a definitely a different take on all of this, because we're dragging our feet, we're doing this, but really everything was completely out of our hands. In Savannah, it takes 6 months just to get in front of an architect. another 3 to get the drawings done and the elevations done. Then you sit and wait for the historical review board, get in front of them. So literally you're at a year, before you're even in front of the board getting permits. And as I mentioned on the big one, all they've let us do so far until now is paint it, put a roof on it, and put the balcony back on it. That house was actually called the Confederate. It was owned by the Daughters of the Confederacy. And if you look it up now, it'll even tell you, it even shows up still as the Confederate. But that's where, all the General Lee and all the big wigs back in the day would stay when they were in Savannah. But yes, it does look extreme, but it's because of the timelines, and it's a unique opportunity. These aren't what we do every day. When we get our hands on them, we know they're going to be good, but they do require patience. We just happen to be so far along in these two that you don't have to have those patience, because we're already roughed in, plans approved, plans done. We just need to get in and get the jobs finished.
Great. Thank you for that answer. Mark, thanks to you as well. Thanks for the question, Mark. I appreciate it. It looks like we're approaching our about the time to draw down. And it looks like there haven't been any questions for a second, but there may be people watching this in the future, watching the recording, that do have questions. But I would like to start off with thanking you, Charles, and thanking everybody who's in the audience today and who's watching this in the future. Charles, if anybody has any questions rewatching this or after they've been able to digest all the information, do you have any closing statements you want to make?
No, I would say, just reach out. And I mean, it's like the old adage, the only dumb question is the one that doesn't get asked. We're very good by, when you call my office and you talk to one of us to on board, it's an interview. We're not out here to just, sell and take in anybody. We want it to be, a match. We want us to all fit together. And be able to work more or less as a team, even though you guys are being the passive ones involved. We want you to manage your expectations, understand your exit strategies, understand your finances even. Is this your only $50,000 to your name? We don't want that investor, because it puts a lot of stress on them, and it puts a lot of stress on us, because they're calling us every day, asking us what's going on. So questions, absolutely again me anytime. I'm great with email. I'm not great with phone, which is why I didn't even put my phone number up here. Yeah, and again, like I said earlier, questions on any type of investment, I'm happy to share my knowledge, even if you're not working with us. I love to educate, and there's a lot of people out there doing it the wrong way. We think we do it the right way, and we just want to build on our network.
All right, great. One more thank you to Charles for joining us today and providing the information. And one more thank you to you all in the audience and the people watching this later. I hope everybody has a great rest of their day.
Thanks, William. Appreciate you having me.
Thanks. Bye.
Okay, bye.